And today you are in for a treat. Why? Because I've asked one of my good friends to come along and give us some information that is very, very pertinent right now, very, very important to your life and to your business. Imagine working in your business for years and years, accumulating assets, making it very, very profitable, creating income, all to be taken away for some unknown reason. Maybe a divorce, maybe partner problems, maybe a death, maybe something happens to you and you have lost all of that. What do you do? It's too late. So I've asked Mike Hiner, who's an expert in this arena of specifically wealth and asset protection and wealth and estate planning. Now, if you're confused as to what that is, he's going to explain why that's important, why he advised me on those things, why I said it's important that he advises my audience on this specific thing. He's based here in the UK, and I've known him for a number of years now, and he's helped me out on many, many occasions. And although you may be listening in from around Asia or Africa or America or around Europe, it doesn't matter. Listen to what he has to say, and if you understand what he's saying, reach out to him, see how he can support you. So, Mike Hiner, welcome to the Business Success Show. Please, 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 I really want you to get this message across to people, how they can protect their assets and protect their wealth into the long term. So before we get going, tell us a little bit about who you are, what you do, and how you help people.
Yeah, great. Thanks for having me on, Mac. It's always good to spread the word with estate planning. I know it has a kind of a reputation really of a kind of a boring subject sometimes, but it's a subject that's really quite important, and people have really got to try and get on board with it really, because it's there's so many things that can happen if you if you pass away ultimately without having a plan at all. So let me tell you a little bit about me. My name is Mike. I run a business called Strategic Asset Protection, and for the last 10 years I've been working with clients, obviously protecting and preserving clients' assets for future generations. So making sure that when they pass away, ultimately what assets they've actually created over their working life fall into trust and pass on in a way that's A, tax efficient, and B, then not going to be lost through the, like we talked about before, like divorces and creditor claims and care fees and all the other attackable events and such like. So it's really about the whole asset protection piece is what I do. Now, my background is ultimately financial services. I started in financial services back in 2000. As a mortgage advisor, mortgage and protection advisor. Did the whole corporate thing. So I worked with Barclays and Halifax and all those sort of businesses to start off with. I then decided that, I could probably do this on my own. So in 2007, I came out of the corporate world and started up my own business, doing mortgages and protection on my own. Just literally as the market crashed. But I thought, well, actually, if I can make this work now, in this kind of environment, I can kind of do this anywhere, sort of thing. So I did mortgages and protection for a good few years, and I was introduced to a company called Countrywide Tax and Trust Corporation, because at the time I was looking to add an additional service to my business that would actually attract more people into my business, as it were. And writing wills for clients and doing trusts and lasting powers of attorney was a good way, ultimately, I thought, of actually bringing clients into that business. So I went through all the courses. Obviously, it started to introduce wills and trusts and such like to the business. And it became quite apparent to me that really what was happening here was that, everybody was doing mortgages and protection, but nobody was really doing the whole wills and the trusts and the asset protection piece to a standard. Yes, you had your will writers out there that were really just doing wills en masse. Come and get it done, kind of, 20 quid, 40 quid, out the door, see you next, on to the next one, sort of thing. But that really wasn't what I was looking to do. I wanted to work with clients, kind of ascertain the assets that they had and make sure that we're building frameworks for those clients to ensure that those assets are fully passed on in a tax efficient and protected way. So in 2016, I started to do the asset protection side of things full time. And that's where the business has just kind of grown from, really. The business is just me. And I think the clients ultimately like that, because it's a personal service. It's me that answers the phone. It's me that does the work. It's me that has the ongoing relationship with them. So what the business isn't about en masse. It's not about trying to see 20 or 30 clients a week to try and come through the doors. It's about working with a particular client, really digging deep into the assets they've actually got, and building a framework and a bespoke framework for that particular client to ensure that those assets are fully protected. But that's the death planning side of things. There's also the lifetime planning. So we also look at, potential inheritance tax issues that the client has today. So there's things that we can do, obviously, within that we can start thinking, well, actually, how can we start reducing down the size of the estate now? So we can look at things like, well, how old are the children? Can we start doing some gifting now, where we gift funds out of the estate to the children now? We don't have to give them a benefit at this point, but we can start getting the funds out of the estate. And then after 7 years, those funds are completely out of the estate, as long as the individual has no benefit.
Yeah, let me jump in there for a moment. So make sure that our audience here are getting it. So here's Mike Hiner, expert in estate planning, wealth and asset protection. Now, some people say, yes, I've got that handled. I've got my asset protection in hand. My estate is planned out, Mike. And yes, my will writer took care of that. Now, this is where a lot of people go wrong. As you explained this to me, a will is not the same as what you do. So please give us a difference between when someone says, I have a will, what is that? And what the difference between what you do. I know you do wills and much more than that. What's the key difference here?
See, the first thing to understand is that it is important to have a will. As a minimum, you need to have a will. And with all the work that I do, my clients still end up with a will as part of the process. But if you've only just got a will, you'll find that a will, basically, back in the days when our parents were young, and there wasn't, the asset, there wasn't the wealth within property, there wasn't the divorce rates and such like. Having a basic will was probably all right, because having a basic will, what it means is that I own the asset today, and when I die, I'm going to pass that asset to you. But the problem with passing that asset directly into the estate of the recipient, as it were, the beneficiary of that asset, is it then sits within their estate. So it's then attackable, should they then get married or divorced or have creditor claims or generational inheritance tax, because the generational inheritance tax is really the main one, other than the divorces, obviously. Generational inheritance tax, if I've created a large, I've got a business and such like, I've got other assets, I'm above the inheritance tax threshold. So if I passed away and I passed everything to my children directly through a basic will, I'm going to pay inheritance tax on my estate when I pass away, but because I've just given it directly to them, it now sits within their estate. So ultimately, they will create whatever they create over their working life, but because I've also chucked on top of their estate, my estate, the chances are when they pass away, that they're going to pay inheritance tax on the bit that they've created and again on the bit that I've created. So that's another, most people don't really realize about that when you're passing assets on directly, especially if you're above the threshold. This is why, again, we want to make sure that we pass assets into trust for the benefit of my children, so they still have access to the estate, to the funds, to the whatever it is, the asset within the trust, but they just don't have ownership of it. So what they're able to do is they're able to come to my trust, they're able to take cash out of the trust, but they take it in the form of a loan from the trust. So, and because it's the form of a loan from the trust, it then doesn't enter into their estate. So if my son, for instance, came to my trust and took £100,000 out of my trust, well then, that's fine. He takes it in the form of a loan. Now, if he then goes and gets married and then gets divorced, well, she's then not entitled to any of the 100,000 that I gave to my son, because it was only loaned to him. It wasn't given to him. If I'd given it to him through my will, well, then yes, she's going to walk off with probably 50% of that 100,000, which, to be fair, for me, doesn't really sit pretty. I want to make sure that what I've created over my working life, because I've worked hard to create what I've created, I want to make sure that it passes to my children and only my children. That it's then not lost through potential, decisions that they make later in life. It's about protecting what I've created. That's what the business does.
So that's what your business does. And it's not just about wills, it's protecting your hard-earned assets that you've accumulated over time. Hey, ladies and gentlemen, if you're listening in right now, you're listening to the Business Success Show with Mac Attram and Mike Hiner. Mike Hiner being the expert in asset protection and also estate planning. We're going to go deeper into this particular subject. It's a subject that not many places will be talking about this. And if you've been listening and watching and been part of my audience for a while, you'll know I bring you experts in areas that help you to either advance your business, protect your business, and have a better business, and above all, have a better lifestyle as well. That's why Mike is here, because as business owners, you know what it's like. It's not just about the daily grind, and working hard for the rest of your life. It's also, how do you advance quicker? How do you become more productive? How do you become smarter in what you're doing in order to have a better business? And the reason why I've asked Mike Hiner to be here is, as a business owner, wherever you are around the world, you need to understand what asset protection is and wealth, and what estate planning is for your own beneficial future. So, Mike, can I ask you, just popped into my mind, we've got people watching in around the world here. I'm sure there's little nuances and differences in particular countries as well. Would that be right?
It is right. Yeah, absolutely. If you've got assets in different countries around the world, you need to make sure that you write yourself a will, or you get somebody in that territory to write you a will for that specific asset. That's really, really important. You can't just have one will that's going to deal with your worldwide assets. So if you have got assets here in the UK, or you've got assets in, I don't know, India, or you've got assets in America, or wherever these assets are, you need to make sure that you do put together a will in those territories to deal with those particular assets.
Okay, very, very good. So, for those of you who are based in the UK, or you have any UK type of related businesses or assets, Mike Hiner is he's a very rare 1% of the people who do this kind of thing. He's one of the top ones here in the UK who does that. So reach out to him. So tell me something. There's a couple of questions that I do want to ask you. Is this? You just now touched on trust and what you can do with trust, and people can access it. And for those who it just went, what did he just say? Right. What is a trust, and how does a trust protect assets?
Well, a trust ultimately is a mechanism where you would ultimately put an asset into the trust. You will name trustees that will manage that asset, and you will then name beneficiaries that will actually benefit from the asset within the trust. It's ultimately, the easiest way to think of it is like a box, really. It's just a box. You put the asset into the box. You give the keys to the trustees that can manage the asset. They can get in there. They can do what they need to do with it. Trustees cannot benefit from the asset within the trust unless they are named as beneficiaries. So all they are doing is managing that asset in the trust for the benefit of the beneficiaries. That's ultimately what a trust is. Been around since the Crusades, trusts, you know.
So
So
since what, the 1200s, 1100s, we're talking about
yeah,
800 years
absolutely.
ago, right? 800
Absolutely,
years.
but they've come to fruition more now because of people's ultimate wealth that people have. You know, they've become more kind of accessible to people, and you know, they're on people's radars more these days because people ultimately want to think about, or they're thinking about ways that they can actually protect ultimately what they've created. That's why they've become more. You know, like I say, they've been around since the Crusades, but they've become more popular in the last few years, as it were, because of the wealth that people have in their homes, and because of assets that people ultimately want to make sure that are protected against things like here in the UK, where you can potentially have your house forcefully sold to pay for your care if you haven't physically got the cash to pay for it.
Hold
So
on. Rewind there. Go back a bit. What did you go back to what you just said? You get hospitalized, and
yeah, so here in the UK, if you need to go into care later on in your later life, as it were, because you're unable to stay at home and look after yourself, and you need to go into care, there's a cost to that care, obviously, which has to be borne. It has to be paid for, as it were.
hmm,
But the problem with a lot of people in this country is that when they buy a house, they will buy a house as a husband and wife. They'll buy it jointly. What that means is it ultimately means that you each own 100% of that house. Okay. It also means that when one of you passes away, regardless of what it says in a will, the the survivor will always receive the property because they own the thing jointly. They own the property jointly. Now, from an estate planning point of view, That's a bad thing. We don't want that. Most people think, well, that's great, we own it jointly. It means I get the whole thing at the end of the day. Brilliant. But from an estate planning point of view and a protection point of view, it's the worst thing you can have. We want to make sure that when we look at property, that you own it, what we call tenants in common, okay, which means that you own a defined share each. Now, that normally is a married couple 50-50, but it can be, 90-10 or 70-30 or whatever it is. It doesn't make any difference. But because the property at that point is owned tenants in common 50-50 or whatever it is, it means then that if one of you was to pass away, their half or their element would fall into their trust, but it would mean the survivor would own just potentially half a house. They don't own the whole thing. Okay. But because they are a trustee and a beneficiary of the other half, they still have full control of the property. So they can still do whatever they want to do, live in it, sell it, rent it, whatever they want to do, no problems at all. But from a care perspective, if you need to go into care later on, they will look at the assets that you own 100% of. And if there's an asset there, a large asset there, like a house that you own 100% of, and the likelihood is that you're not going to come back to that house because you're now in residential care, they can forcefully make you sell that property in order to pay for that care. But going back to the planning we talked about before, if we own the property tenants in common, because my partner passed away and I was left owning just half a house, well, now there's no value to half a house. So from a care perspective, they can't make me forcefully sell this property because I don't own the whole thing. Right. I only own a proportion of the property. So we've got round having to sell the house now to pay for the care just purely by severing the tenancy on the property. Again, not many people know about that, because most people and most conveyancers, when you buy a house, will do it as a joint purchase and not tenants in common. So wow. Any assets that you've got, we always want to make sure that all the assets that you've got, ideally, you don't own solely, because if you own it solely, then it's attackable. And that's exactly the same when I have an asset, and we were talking before about a basic will. If I've got an asset here today and I give it to my son on death, well, then he owns 100% of it. So again, it's attackable then, but in his estate, not my estate. So that's again why we want to make sure that these assets are falling into trusts and he has use of, but not ownership of those assets. So they're not attackable when they pass on to him.
Mike, tell me something. So why do you think most people don't know this? And why is it people naturally think, oh, at some point I need a will? Or I'm at the age of 50, I need a will. At the age of 60, I need a will. 70, I haven't got a will. I need to get a will. My best friend's just died. So why is it people naturally steer towards, oh, I need a will, rather than I need to protect my assets? Why does that?
In simple terms, it's because what most people know. In simple terms, you go to the solicitor normally to get your will sorted out, 9 times out of 10. And because the solicitor acts on instruction, you walk in there because you don't know anything else. You go, well, I need a will. And the solicitor will go, well, great, what do you want in your will? And what you ultimately end out walking out with is a will. Not knowing at that point that actually what you probably needed was a little bit more than that, absolutely.
So, yeah, go on.
No, I was just going to say, but the planning that we're talking about, it isn't just for the kind of the ultra high net worths. A lot of people these days have sufficient wealth within their properties, that's going to take them up to or above the IHT, inheritance tax threshold. So, the planning that we're talking about is an everyday kind of planning. It's not just specifically for the super high net worths, as it were. Anybody can have a trust. If you've got an asset, you can have it put into trust. So it hasn't always got to be just for those, those super rich people, as it were.
Well, that's a good point you just made. I love the way you put it as well, because trust are synonymous with ultra high net worth people. And you're saying, look, no, actually, you can have a trust for yourself. It doesn't matter what, because most people are sitting on assets. Maybe they haven't even considered that they've gone over the inheritance tax.
Well, again, see, a lot of people don't realize that they're actually wealthy because the wealth is actually sitting within their property.
Right.
They only realize it when the council is saying to you, actually, you now need to sell this property because there's, 300, 400, 500,000 pounds of cash sitting within it, equity sitting within that property. Right. So it's about, well, that's money that ultimately you've paid. You've worked hard, you've paid your mortgage at the end of the day every month for the last 25, 30 years or whatever it is. And why is it now that at the end of that, you should then have to sell that property just to pay for your care? That's, to
Well,
me, is not right.
yeah,
Why we're out here doing what we do.
yeah, no, that's it's good that you are doing the kind of work you do, because for those who are fortunate enough to stumble across you, like myself, it becomes the conversation. If someone says, "Hey, I need a will," you have the know-how to say, "Actually, let's talk through this." And I know you've done this, and you take them through a process of asking the right questions to actually, they thought they need a will, but what you come up with is they need all, they need this and this. Because why do they
Yeah.
want a will? And you explain. Do you have a? Can you talk through your process
Yeah, see,
slightly?
you're exactly right there, see, Will, Mac. All of my clients, most of my clients that still come to me, still think when they come and have an initial conversation with me that they need a will, because that's kind of, they've been prompted to come and speak to me because they feel that they need to have a will. It's not until you actually get down and you sit down with those clients that actually it becomes quite apparent that actually a will is just not going to be sufficient on its own for you. So again, it's a process of just having a conversation, really. I mean, my process really is, obviously we have an initial conversation where I do a fact find, which is all about kind of the assets and liabilities, working out what assets you've got, what class of assets you've got. And then what I then do from that is I take that information and I put it into a 20-page bespoke report for that particular client, explaining absolutely everything that's potentially needed in order to protect the estate that they've got of the size that they've got. We talk about potential inheritance liabilities, inheritance tax liabilities within that report. And that is ultimately then the framework, obviously, that we would then put together for the client. So we will then talk through that recommendation with the client. And if they're then happy with all of that, then we start the process of actually putting all those documents together. We then have a signing session, and that's it, pretty much done. It's then a question of the ongoing relationship, because once this is set up, it's about managing it through as well, because obviously people's estates don't just stay the same. Things happen, life events happen, so it's about maintaining that relationship on an ongoing basis. So every 2, 3, 5 years or so, we'll have a conversation about, well, where are we now? The planning that we put together, is it still sufficient? Do we need to add anything into this? Those sort of things. So just an ongoing relationship.
And tell me something then. Yeah, we've got lots of business owners here listening in and entrepreneurs listening in. How, in terms of what you're saying, is it the same way in terms of them protecting the business that they've spent years developing? How do they protect that business?
Yeah, well, the
Outside?
first thing to talk about when it comes to business is that you need to figure out whether or not you're in business as a sole, like I am. My business is just me. There's no other directors, no other shareholders within the business. It's just me. Now, a common error that a lot of people make when they start off in business is they start off in business with a friend or a colleague or whatever it is. So the joint shareholding, or one's maybe a slightly higher shareholding than the other. But what they then don't do is they don't protect that shareholding at all. What I mean by that is that if Mac and I were in business together here and we were 50% shareholders and we had £1 million business, let's say, if I passed away, my shares at this point will fall into my estate and pass on to whomever I've decided to leave those shares to, which leaves you in a bit of a position now, because ultimately you could be in business with either my wife or potentially even my children. But if I haven't even got a will, well, then we don't even know who you're going to be in business with, because those shares could be passed to whomever, because ultimately the government are going to decide ultimately who benefits from those shares later on. Because the government, when you pass away without a will, you die what they call intestate, which means ultimately you get the government will. And what that is a strict set of rules that lay down who benefits from your estate. And chances are the people that are going to benefit potentially could be the ones that you probably wouldn't want to benefit.
Mm.
But that's, another reason why you ultimately want to get a will. But going back to the business side of things, because ultimately you don't probably really want to be in business with my wife or my children or whatever,
Yeah.
what we would want to do, but most businesses don't do, is set up what we call a cross option agreement, which is an agreement that states, if I passed away, I would give you, or the business, my shares, and the business would pay my wife the
Mm.
value of those shares. So if we had £1 million business, I'm going to give you £500,000 worth of shares back to the business, and the business itself will pay to my family, my estate, £500,000. So you can then manage the business, continue to manage the business however you want to manage it. My family have been compensated for the shares. Everybody's happy. So when I go back to the cross option agreement, the cross option agreement is kind of like the insurance bit of it. You know, it's the mechanism of how the shares cross to you and the cash comes to me. But the business ultimately would take out a life insurance policy over me and over yourself for the value of those shares. So that when I passed, obviously the life insurance paid out into the business. The business was then able to give my family in trust again, because we want to make sure that that life insurance policy is paid into trust, because again, that's going to create me even more of a problem if it's paid directly into my estate. Because again, if it's paid into the estate and it takes me above the threshold again, I'm going to pay 40% tax on something that really should have been tax-free. So we want the life insurance policy to be paid into trust, and we want the shares, my shares, to be paid into a share trust. We don't want the shares to go to you, because if they're paid into a share trust, again, they stay with the business, and I'm not creating you a problem later on down the line either. So the business is within the share trust. You're a trustee and a beneficiary of the share trust, so you can do what you want to do with the shares. You're in full control. My family have been compensated. Everybody's happy. But that is one thing that most businesses do not have. It's that kind of, okay, well, what are we going to do now? You know, because again, ultimately what would happen is that if you decided actually the shares came into my, you know, to my estate and my wife was now your business partner, you would probably say, well, I don't really want that. So what we're going to do is we're going to close the business, and I'm going to start my own business again, you know. But again, there's problems with all that, and that can all be solved just by simply putting in a cross option agreement.
And in that instant where we say, I say, I don't want to be in partnership with your wife, I don't want it to be my business partner, let's, you know, the business is now null and void. So that asset now is, it actually just crumbles and it's gone, rather than being protected, and both
absolutely
win.
But also remember, you know, think about the situation if I was a majority shareholder and I passed away, and now my wife now is a 70% shareholder and you're only a 30% shareholder. How motivated are you going to be to continue to work to make money for my family? Probably not.
Probably not. Probably not at all. It's a good point. Can you give? I'm thinking. Can you give a couple of examples so people can really get this as to why this is important? Obviously, don't mention any names, but just incidences where potentially what would have happened is this, or you know, when someone came to see you and had they not done what you had said, potentially what would have happened is this. You know, I know you.
You mean around the business, or are you talking about?
Just generally. So, you know, our audience are entrepreneurs and business owners, but I want you to talk individually. So they they've got a business, they've got some property, they've got a property they live in or a property they rent out. They've got all these assets. And I suppose the example I'm looking for is maybe it could be the hospitalization type scenario. It could be, you know, you've given a business partner type scenario. Yeah. So we get that. What else?
Well, let me give you this example. I did some planning back end of last year for a couple. They'd been together since 1994. So they started a business. They had a business together. It was a cattle business. So they owned a farm. The problem was that the farm itself, the land for all the farm, was in his name. Yeah, everything was in his name. So the land was in his name. The business was a joint business. They owned it together, as it were. They both put money in to be able to build this house. They put a big farmhouse on this, you know, nice modern farmhouse on this land. So the client had put, you know, Mrs. had put some money into it, as it were, and Mr. But they were unmarried. They weren't married at all. Okay. So, and Mrs. wanted to be able to have half of the estate, because she felt, well, actually, you know, I'm entitled to half of the estate because ultimately I put money into it. We run the business together and everything else. It's just the fact that, you know, but the problem is when you're not married, you don't get what they call spousal exemption. Okay. Now, spousal exemption means that if you're married and when the first of you passes away, regardless of the size of your estate, there is no inheritance tax to pay until second death. But you only get that if you're married. So these two obviously weren't married at the time. So what it meant was that if he wanted to gift her half of the value of the farm, we're talking £3.5 million at this point, the capital gains liability on it, on the disposal of half of that, was absolutely astronomical and completely unaffordable. So it was unachievable. We were unable to do it. The only way we could do it was if they got married. So that's what they ultimately decided to do. They got married in the end, and we did a conveyance. We transferred half to her, and that was that.
But had they not spoken to you?
Legally.
Wow, that's just amazing. I've never heard anything like that. So
had
they not spoken?
Hundreds of thousands of pounds on that, just by getting married. So they just had a simple registry office on a Thursday afternoon, I think it was, got married, and then a week later we were able to do the conveyance and transfer at half.
Wow, ladies and gentlemen, welcome to the Business Success Show. Thank you for tuning in. Thank you for listening in. This is the reason why I like to interview experts, because when you speak to an expert, you will learn more than what you know right now. And when it comes to the expertise of asset protection and estate planning, Mike Hiner knows more than most. He's at www.strategicwills.co.uk. And, you know, I'm sitting here thinking I know a lot, and I'm still learning right now from what you just said. And that is just mind blowing. They weren't married. Potentially we're in a situation to lose hundreds of thousands of pounds. But by them speaking to you and you being able to advise them expertly, well, that is, they were able to do something that maybe they were resisting for years. And so what's the point? We're happy.
Yeah, that's right. Yeah.
We don't need to get married, right?
Indeed. It's very, very common. It's very, very common. You know, I'm dealing with a case at the moment which is pretty much exactly the same. You know, not married, got children together, own a house together, as it were, jointly. But again, what they don't realize is that, you know, if you haven't got a will to start off with and you're not married, you know, and you've not named any, you know, your partner, your life partner as a beneficiary, then they're not entitled to anything. Nothing at all. In the rules of intestate, you're not entitled to nothing at all. Even though you're the mother of the children, nothing. It will all go to the child. You know, so I'm dealing with this case at the moment, obviously, which is exactly the same thing. He has all the assets, you know, lots and lots of assets. There were lots of cash, businesses, the whole lot sort of thing. But ultimately, you know, no planning at all. But ultimately, if he passed away, the initial inheritance tax liability on his estate, on his death, will automatically mean that, you know, half of the assets will have to be sold in order to pay the inheritance tax. The property potentially may need to be gone and everything else, purely because they're not married. You know, whereas if they were married, well, then we can defer that inheritance tax liability until ultimately she passes away.
Amazing, amazing, amazing. Well, it's been a pleasure you really educating us in this arena, a subject that not many people talk about, but very, very important for entrepreneurs, very important for business owners, very important for individuals. So before we finish off in a moment, Mike, for those who are based in the UK or they have UK related businesses, or they, how can they reach out to you? What's the best way for them to contact you?
Well, you can come through obviously on the website, you know, www.strategicwills.co.uk, or you can email me direct, which is mike@strategicassetprotection.co.uk. So mike@strategicassetprotection.co.uk, or you can contact me on the phones, you know.
So people call you and just say, "Hey,
yeah, absolutely. I'm here in the office most days, so right. You know, absolutely, you can always get hold of me. Absolutely, always here to chat."
Okay, very, very good. You've been listening to the Business Success Show, and if you want to make sure you are protected and you are building wealth for the long term and sustainable, then I would reach out to Mike Hiner. I have done that. He's helped me a great deal. And he'll open your eyes to things that you may not even have thought about, because this is what he does day in, day out. And he's been doing that for more than 10 years in this capacity, more than 20 years in other financial instruments as well. So on that note, I want to say thank you, Mike, for being here to educate us in this particular arena.
Thanks for inviting me.
Any final words before we finish?
Yeah, just really, if you haven't got any planning in place, you know, reach out, let's have a conversation, and let's see what we can put together for you. Absolutely.
Awesome. So potentially, if you want to save yourself hundreds of thousands of pounds or millions even in some cases, then speak to Mike, okay? www.strategicwills.co.uk. Check him out, expert at what he does. Thank you very much for tuning in. Mike, thank you for being here, and we'll catch up
Welcome.
very, very soon.